Hi, everyone. This is Jeff Praisman with the IBKR podcast. And today we're going to dive into one of the most talked about trends in modern option trading, zero DTE options or 0 days to expiration. What they are, where did they come from, and where are they going? With us is derivatives strategist and expert Sean Feeney, the former head of U.S. options at Nasdaq. And he's here to break it all down for us. Hey, Sean, how are you?
Hey, Jeff, I'm doing wonderful. Thank you for having me.
Always a pleasure to really excited for today's segment. Sean, we've covered this topic quite a bit over the past few years, but I always like to start simple. What exactly are zero DTE options?
Jeff, you're touching my heart. Zero DT options are option contracts that expire on the same day that they're traded and have become quite popular over the past few years. And traditionally, options have expired on a monthly basis and going all the way back in time on the last day of the month. And then it became the third Friday of the month. And then in 2005, and then more into the single stock space, 2009, 10, 11, became more weekly and expiries were happening on each Friday. But demand for some more precise risk management tools have led to expirations, especially in some of the most highly traded instruments that are daily expirations. And that's what we really call zero DTE. And they've taken off on the retail side. They've taken off with institutional traders as well. And a lot of the strategies around zero DTE have to do with either gamma scalping or event trading, some intraday hedging, and then naturally, of course, a bit of speculation as well.
Yeah, I was just going to ask you. You gave a nice, concise rundown of I guess the life cycle of options listings there.
Yeah.
So they're clearly relatively new, these zero DTEs.
They're new in the sense that the products have evolved to the point where options are expiring daily. However, the actual zero DTE event and the first zero DTE event came on July 31st of 1973, which was the first day of an options expiration. And you could have traded, I believe Xerox was one of the stocks that was trading in the early rounds. And you could have traded Xerox options on that day of expiration. And that could have been zero DTE. The difference between the past and today is that we have much more frequent expiration cycles today, allowing for more zero DTE trading and for the popularity of strategies surrounding and utilizing those instruments to really take off and then hit home with either the retail community or the institutional community.
And there's been some, for the most part, though, they've been pretty much indices and ETFs, right? But there's been some pretty big news lately, right? Nasdaq's basically filed the list Monday and Wednesday expirations on individual stocks, which is sort of taken to the next level, right? Like we had the usual suspects of our index. And so now we're like going into some, individual stocks. So what's going on there?
Hey, sure. I'll give a brief history from the past, right? So 2005 listed weeklies, and those were Fridays. And then in 2016, SPX started to offer Monday and Wednesday options. And then SPY and QQQ, the ETF tracking stocks for those major indexes, started to list the Mondays, Wednesdays, and then the Tuesdays and Thursdays. And then last year, TLT, GLD, SLV, UNG, and USO, all commodity-based and rate-based ETFs, began to expand their expiry profile. And now you have some more expiration. And this is a phenomenon that I like to call continuity of product. And as product becomes more continuous, the availability for hedging is really interesting. So that latest news that NASDAQ recently filed with the SEC is to allow Monday and Wednesday expirations on 9 very liquid securities. And these are 8 stocks and 1 ETF are within that filing. And right now, zero DTE, as we are talking about it today with non-Friday available expirations, they're available for those indexes and ETFs. But this filing, which is not approved yet, it could really unlock it for stocks. And that they all have the same structure as existing options. And this is huge because it brings that continuity of product into the individual equities to just not really the broad market positioning.
Now, Sean, why now though? Because I'm just thinking about this, and there's certainly significantly more unsystematic risk associated with single name stocks versus an index or ETF. One example, right? Earnings, right? Earnings come out, or the day changes, or even just any kind of company news event that might be out of the ordinary. So I'm just curious why the exchanges felt this was a good time to bring these into the forefront.
And this is a great question. Now, I'm not with Nasdaq anymore, but I did a bunch of work on this prior to my leaving, and really two reasons. So trading demand, you have people who wish to have short-term exposure and tools for individual names that do move around a bit. And secondly, it's really the volume and the liquidity within these mega cap names is really there. And Nasdaq is being smart about listing these, and they're not allowing for listing of options, specifically Wednesday or Monday options, on an announced earnings date. There are typically a large outsized move after hours that could impact and or force an individual to take action. And there's a little bit of controversy around that, but it's going to be a really interesting environment. And I'm looking forward to reading through the public commentary as that filing's in its comment period, and then seeing exactly what happens with the approval process and whether or not these get approved.
Now, I got to point out too, though, zero DTEs are probably overall taking a huge part of the option volume, correct? But critics also, there's critics of them, right? They say they're too risky. They have some fast losses, draw speculation. Some even equate it to like betting the over under on a game. Is this really a fair comparison?
These are fair concerns, but it's really all about education and intent and how you're using these options. Because used properly, zero DTE allows for an incredibly efficient risk management. For example, funds use it all the time to fine-tune exposure heading into macro events or to manage kind of their intraday hedging processes. And do retail traders use these products? Absolutely. Is there a risk? Yes, of course there's a risk, but that risk is no different than using other leverage tools or using options that were expiring on a Friday or monthly options and then trading them on the date of expiration. And if you really look back in time and you go back to 2012, 2013, 2014, and look at all of the data all the way through to today, you'd see that 40 to 45% of any option on the date that option is expiring is typically going to trade in that instrument that is expiring, that zero DTE instrument. So as more instruments and more expiries are added into the option chains, you'll see an increase just naturally based on the amount of product that's available in the overall amount of zero DTE trading. But these tools are very powerful and they can be used by anyone. And if that NASDAQ proposal does get approved, I would like to really see what the effect of these options is on the securities which they are overlying. So it's going to be an interesting time period coming up.
And another thing I like to point out too, because no one really, a lot of people, I shouldn't say no one, but a lot of people don't really think about, like even people that trade options, they don't think about all the work that goes in behind the scenes, under the hood. And another concern I've heard, especially from clearing firms and for our listeners that aren't familiar with the underworkings of options, essentially there's a central clearinghouse that makes sure that, to put it very simply, make sure there's no risk that I buy an option from Sean and Sean defaults and I never see it. So the clearinghouse makes sure that everything's on the table, everything's up front, and everyone has everything financially keeps everything stable, for lack of to keep it simple. The amount of work, and especially from these retail operations desks and clearing firms, talking about the contrary exercise intent of the CEI, the notification windows. Some are arguing that adding these single stock expirations is just really adding to the complexity that's an operational complexity that's already very complex and adding more risk. So, what's your take on this?
Again, spot on, Jeff. And this is a real issue underneath the hood of the options market, and that industry vets have been speaking about very passionately over the past few years. When an option expires in the money by a small amount, the default rule is to automatically exercise those options. But if a trader doesn't want to exercise those options because of news or a post-close movement, they have to submit what's called a contrary exercise notice to their firm, their trading firm. So the two main problems here is that the deadline for submitting one of these contrary exercise intent notices is typically 5:30 p.m. Eastern. And that's an hour and a half after the market close and plenty of time for potential news events that could be market moving in an individual underlying. So for firms handling thousands of accounts and managing all of these contrary exercises every day, potentially now 5 times a week per stock where you have options that are expiring every day, there are definitely workflow pressures and operational risk that is taken on as a result. Now, secondly, for the retail traders, even experienced ones, they aren't fully up to speed about their responsibilities for post-close moves and expiring options positions. That trader that has an option that's expiring might not even have enough of a cash balance in their account to take delivery of an underlying security or be authorized to establish a short position in the underlying security if, for instance, the option closes, or I should say they have a call option and it closes out of the money at 4:00 Eastern. And then by 5:30 Eastern, the underlying security is $2 or $3 or $4 or $5 through the strike price. And then the holders of that option end up exercising that option in a contrary fashion. Those who are short that option can then be assigned and then have to deliver short stock. And they might not even be able to do that. All of this said, I still absolutely support the expansion because technology is catching up. Many brokers and OCC members are automating their CEI workflows, the contrary exercise intent workflows, and the industry is already discussing whether or not that 5:30 p.m. window should evolve to match the pace of trading. And it's really a speed bump and not so much a stop sign. These post-close moves make exercise versus lapse decisions non-obvious. And clearing firms will worry about the missed notices that lead to position errors, and all of that will happen behind the scenes. But operationally, should be seamless. Just make sure that you're educated about your responsibilities. Most notably, noting that if you are a holder of an option, you have all of the rights in that contract. And if you are the seller or if you are the writer of that option, you have nothing but obligations. So if you have expiring options and you are looking at 4 p.m. Eastern and saying, oh, I'm short this call and it's close, but it's not really there, and my firm didn't close me out, there is still risk. And you should absolutely take a look back, check in, make sure that you understand where that underlying security is trading around that 5:30 time period. And you should not have any issues. If you do, please, by all means, reach out to your trading firm partner.
So while the trading tools are evolving, the plumbing underneath is really still evolving as well, and we need to make sure that both are going hand in hand.
Yeah, exactly. And we've innovated on the front end of this trade. Now we need the back end, which is operations and risk and clearing infrastructure, to evolve in parallel. And I think Nasdaq's cautious rollout of only 9 names, no earnings date, really shows that they understand that too. And again, this filing is still unapproved so far by the Securities and Exchange Commission, is in its comment period, and there is hot debate around it within the industry. So we might be putting the cart a little bit before the horse talking about it today, but I think it's something that your listeners should absolutely be made aware of, the opportunity to potentially trade Mondays and Wednesdays on some of their favorite underlying securities.
No, it's a great conversation. I'm glad we're talking about it today. And it leads me to my next question of where do you think it goes from here? What do you think the option space looks like in, say, the near term, say 1 to 3 years?
And on the zero DTE side, I think we're really just starting, because we have more underlyings, potentially these single names, sector ETFs, and global indices. But the industry will remain mindful of public sentiment and the marketplace demand and will carefully weigh any risk and reward before proposing any additional securities to add to this program or any of these buckets. There's potential for some more differentiated strategies. You can even have these AI-driven execution of zero DTE spreads, and you can have these artificial intelligence programs searching for the right strikes to trade in given instances. And with better regulation and oversight, especially around volatility spikes, what Nasdaq is proposing, it's part of a long-term evolution towards a full menu of option products, one for every time frame, from the zero DTEs all the way to the leaps. And it's the next step in creating a truly continuous, flexible options ecosystem. And product continuity is incredibly important. There's plenty of potential for even CFTC and SEC collaboration on some of these higher frequency activities. And I think it's a really interesting place to be right now.
So final thought, Sean, should traders be excited about this expansion of zero DTEs?
Oh, absolutely. It's a forward-thinking move. Zero DTE options give traders precision and choice. And again, that continuity of product lets a trader or trading firm strategies evolve without calendar gaps. Used wisely, they can be a valuable addition to any toolkit. Education has to be essential, but the future of options today is faster, it's more flexible, and it's more customized than it ever has been before. So I'd say absolutely traders should be very excited and continuously looking into different ways to trade their favorite underlyings. And if you have any questions, Jeff, you know where to find me, but everybody else that's listening here is going to have to find you.
Sean, thanks so much for joining us. It's always a pleasure to have you here in the podcast studio. And for our listeners, obviously, if you're interested in options, keep your eyes out for the ongoing fluidity of these SEC approval processes, the zero DTEs, and everything else option related. You can find all our great podcasts on our website under education. You can go on any of the usual sources such as Spotify, Amazon Music, Apple Music, and so forth. And until next time, look forward to seeing you guys back here. Thank you.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or OD, which may be accessed through the link found in the podcast description page. Multiple leg strategies, including spreads, will incur multiple transaction costs. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.